All right, guys, welcome back for another video. In today's video, I'll be covering the topic of Wyckoff accumulation and Wyckoff distribution. And I think this summer 2021 consolidation in Bitcoin is a textbook example of Wyckoff accumulation for a couple of reasons. First being, one determining factor is you're coming off a very significant downtrend, and then you get this higher high created here, and then a lower low created here. This is a very key component of Wyckoff accumulation. We'll revisit this later, but then essentially get this higher high, lower low, and then this lower low sets in low. And some Wyckoff schematics, they will come down and test this low for a third drive. You've got one drive here, second drive, third drive. Sometimes comes in, sometimes it doesn't. These are really the key variation in the different Wyckoff accumulations. With that in mind, it doesn't make a whole lot of sense to trade, to put a stop loss at this level if you are trading this as a Wyckoff accumulation, because oftentimes price can come down, test these lows, come down, run stops, and then run up very quickly. So if we see that, this would be a situation where you do get that spring and then test, and you can see the higher high here and the lower low here. This is really the key component in the volatility sequence here. Now just going over to the other schematic, you can see that there is no spring. This is a situation where there isn't a test of the low right here. There's no third drive, but this volatility expansion, the higher high here, is in place right there. And typically what you see here is, this will be a downtrend coming, a very significant downtrend coming into some type of high time frame level right here. And then price will bounce off that level, often fill a price extension from price, pausing here at some level, comes down, fills the price extension, lower retrace into a higher low, and then you get your run up, your expansion of volatility here, higher high, lower low. This is confusing and taking people off both sides of the market with this expansion of volatility, then a retrace, a little bit of sideways price action. That's really exactly what we see here. See this higher high, lower low. And this is the key component of the Wyckoff that I want to focus on, because really this can be very frustrating if you're not aware of this possibility and this stops you out or gets you on the wrong side of the trade. And this ties into a component of my methodology, which is that anytime you come off of a very volatile expansion like this, I don't want to play the first breach of liquidity as is a break of structure, even though it is textbook. I mean, this is textbook, according to the book, a higher high on the daily. But in the consideration of the overarching market conditions, in the rule that I always want to fade the first pass. And the way I describe it is fading the first pass of volatility. If you do that, typically the first pass coming after this volatile expansion will be a fake out, a swing failure pattern. And that's what we see here. And then price comes down and starts playing out according to the Wyckoff accumulation. Again, it doesn't have spring here, so you probably don't want to have a stop loss right here just in case it does wick below these levels. You probably want to manage with something more along the lines of manage off a daily closure, or maybe a 3-day closure, some type of high time frame closure below this level, rather than a stop loss. So really that's the key component in my mind of Wyckoff. The benefit to trading these formations is that if you get it right, you can get a pretty trending play that you can just hold on to and make money without really needing to actively manage. Typically it catches a trending move. And same situation here. This is a little bit different. You have the 3 drives as opposed to 2 drives here. You've got the 3 drives distribution, Wyckoff. Now this doesn't adhere to the model perfectly because you do have this retrace here. This is a trade actually I took earlier in 2021, but you sort of get the idea, right? So whether you mark it off as this trend line right here, and you can make separate arguments about what was structure broken here, or was structure broken here. You can make a valid case for both. Again, it's a good example of how technical analysis is not perfect. It's an art, not a science. But the general idea is you get this distribution, You get a break of structure in the market, and then a retrace into a bearish 618, sell off. This is your distribution model. Now it doesn't, perfectly fit. You got your 3 drives, and then you get lower. You do have a low SOW in phase B, but here you don't really get that significant retrace in the schematic. You actually get the a retrace more in the schematic number 2. So you get, here, then a retrace up here. But again, the idea is that, you have these expansions of volatility. So, you could mark off that level as being this here. So you have this shelf low right here, price pause low. Now, this doesn't look very significant on a daily, but if you were to go down to a 4-hour, you would see that this is probably some area where people would have stop losses. And so, you do get a test below those levels, and that's your volatility run, your lower low, and then you get the breach of liquidity above. So going back to there, that's kind of the what you're seeing right here, and then you get a third test. Now, again, we didn't see the same type of retracement here, but one inference we can draw here is that we see this this lower low. That is a key component of the distribution schematic. We know that a lot of times impulsive price movements come in when these lows are violated, meaning that this is not an area where price is generally going to run down and then swipe the lows below here and then rally off. Typically, you'll see this type of price movement, right, where you get a very fast capitulation, and price, runs these lows, and that sort of lines up with what you're seeing in the schematic, right? Once the distribution schematic is complete and starts to play out, you do get a pretty dramatic price action movement. And that kind of lines up with what we were talking about earlier. Like, if you are able to trade these correctly, they offer very, very good risk reward. Sometimes it can take a good deal of time for these things to play out because, like, for example, this one, the structure starts to break down. Really, here is so April 18th, 2021. So it does take a few weeks to play out, and that can be a little bit frustrating and a little bit nerve-wracking. Actually, I took this trade, and I remember watching Elon Musk on SNL when price was up here, and trading this as a 618, and I got in here at this price level, and price. It felt like price was running for my high right here. Felt like I was going to get stopped out, but ultimately the trade played out very well, and that kind of goes along with what we were saying earlier about, if you do catch it, typically the Wyckoff leads to very impulsive price movement, trending behavior, and the type of trade that you can hold on to, right? Or the type of trade that everybody looks at, and you wanted to grab a short here, ride this move, because even here, this is a trade you could hold on to. I mean, really, if you held on to this from May to July, that would have been good. And the same thing here with this Wyckoff accumulation, right? You could have held onto this. Really, hopefully you'd be taking profit along the way, but really you could have held on to this from July all the way to November. Anyway, I hope you guys like this type of content. If you guys like these videos, please just make sure to leave a like and subscribe to the channel. I'll catch you guys in the next upload.